What's up traders, Tom here with another video. Today we will be discussing investing during what is likely to still be a technical recession and whether what worked before will work again in the future. We will also be taking a look at our thoughts on the current state of the US stock market. Stay tuned. So to begin today's video, I want to talk about the phases of investment and the phases in terms of picking a sector and picking different phases so you can choose businesses in those cycles. Now, because of the Federal Reserve's intervention in the markets, everything has been blown partially out of whack. And in terms of what you expect and what is going to happen, it's going to be a little bit different. And that's why so many stocks are already coming out of their recession phase and going straight into growth phase again. So usually you see these kind of four phases: an early cycle phase where the economy is rapidly recovering from a recession, which looks like it's what's happening right now. We've got the mid-cycle phase, which is the long phase that you want to usually be invested in. And that usually goes for around 4 to 6 years. And then we have the late cycle phase, which we technically were in already in the US market and other markets around the world. And that's where you start to see incredibly high valuations. And generally the best sectors in that phase have always been utilities, healthcare, consumer staples, energy, those kind of things. The recession phase is the one though that we're kind of talking about today. And that's because while we could be in an early recovery, there are many signs that still say we're in a recession. So what do we do? How do we pick stocks? Well, it's a good question. So as I mentioned before, if you could look up any article, and Investopedia, I guess, would be where a lot of basic traders go to first, which is fair. You have consumer staples, grocery stores, alcohol, cosmetics, all of these kind of staples that people always need to use. And this is what this particular website looks at. As we mentioned before, usually during the contraction phase or the phase where the economy is in recession, some energy, utilities, healthcare, and consumer staples perform better in the stock market. And in our course, we talked about this quite a lot. So what about consumer staples right now? Does that make sense to invest in? Well, here we have Costco, and I've got a monthly up just to show you the rise of Costco since the GFC. It actually sold off a relatively large amount during the recession pullback. And it went back around almost about 40-ish% during this period. So Costco is not really a buy, it's not really a sell, it's more of a hold at the moment if you're in the stock because of its valuation. It's very high and that has merit, but at the same time, is that an opportunity? Possibly not if you're not already in it. So one of the things that I never see written about enough, and this is not a video where I condone fast food or I think it's good, but it's the unfortunate truth of human psychology, is that often fast food and these kind of companies do well during periods of recession and during periods of uncertainty. So why is this? Well, firstly, the fast food industry is one that typically holds up well during recessions as cash-strapped consumers tend to scale down their spending when times are tough. What are we looking at right now? Tough times. Obviously, the Fed has injected money into the economy and that's going to go somewhere, and a lot of people are speculating it's going to go all into the stock market, and that's why we're seeing these prices. But at the same time, we need to think about, unfortunately, there is a high level of unemployment. We are most likely going to be looking at a stock market that is at very high levels when compared to the real economy, where we're going to see a high level of unemployment. And during high levels of unemployment, people tend to eat McDonald's. There's a really interesting point down here in this article, and that says, in fact, McDonald's was only one of 2 stocks in the Dow Jones Industrial Average to increase in value in 2008, so the GFC, along with the retail giant Walmart. So remember, penny pinching, people go and they go to the cheapest places that they know of. And unfortunately, if you have things like depression and all these kind of things that happen around times of unemployment, people go to comfort food, and McDonald's is certainly one of those. So this is not about doing the right thing. I'm just saying this is the investment opportunity that people look at. So here is the most recent, I guess, earnings report for McDonald's. McDonald's earnings fall 17% as, of course, the current crisis leads to restaurant closures, plunging sales. Well, absolutely, it makes sense this would happen. If you have closing stores and you have a lockdown economy, of course, their profits are going to fall, and of course, they're not going to do as well. But I'm talking about when the economies are opening back up, which is happening now. What is going to happen? Well, most likely we are going to see some jobs come back in, potentially still, I've always said the second wave, potentially other things happen. But wouldn't you rather be in a stock that you know has some form of recession-proof probabilities? It has reasons why it can do better than maybe a growth stock during that period. It's kind of like you're hedging your bets. You're saying, okay, I want to be in the market, but I don't want to be in a growth stock that can get absolutely plunged. So when we look at McDonald's share price in a moment, we'll actually see that it fell heavily into this crisis. But it makes sense because it was looking like every single one of these restaurants would need to be closed, and that would hit cash flow, and obviously franchisees would hurt, and all of these types of things. So here we've got the analysts' ratings on McDonald's. So we have 34 analyst ratings, and they say buy. In terms of what their expectation is currently, the average expectation is $202 per share, and the current price is $187 per share. The price has ranged higher than this over the period of time as well. I believe McDonald's has been as high as around $220 before this current crisis. So McDonald's is a strange one because is it close to where the 12-month target is? Yes. Are so many stocks over the 12-month target right now? Absolutely. And you don't have to buy it here. You can buy it at the time that suits you. So when we're talking about where you buy stocks, one of my favorite things to do is I like looking at the 5-year average in terms of PE. I like looking at the current average in terms of the industry. And then I think about, well, where is it right now? Now, we're seeing a lot of weird PEs, and that's the nature of when you have a bad earnings report that doesn't make sense to what's going to happen in the future. But this is a generally good yardstick. If you're buying the stock underneath, and it's a quality stock, and you're buying it underneath when something's going a little bit tough, then it's best to sell it when it goes over by a certain amount. Notice how these two peaks are very similar to each other. We have around 26 times earnings being where it taps out. Now we have to ignore this earnings because it doesn't make any sense because of the current climate, but you want to be thinking about where to get into the stock. So this particular stock makes some sense when we think about its recession-proof properties. Unemployment, again, is going to remain high. When unemployment is high, people penny pinch. When people penny pinch, they purchase this kind of food. It's a reality that we've seen happen time and time again. Is McDonald's the best fast food in America? It's probably not. I'm sure many people don't believe it is. Actually, let me know down below, because I'm Australian, of course, which is your favorite fast food franchise. I believe a few people are going to say Chick-fil-A. I haven't had Chick-fil-A, but I've heard it's pretty good. And when I go to America, I will definitely eat some Chick-fil-A. So it's just a shame we can't buy it on the stock market because I believe it was never allowed. So let's have a look at McDonald's share price. Well, here we have the McDonald's share price. We can see where it went to, which was during 19, it went as high as around $220. It's currently trading at, it looks like about $187.59. Pre-market, about the same. And it went down to around 170. So it pretty much is trading similarly to maybe the S&P 500. And we remember this big fall off, while it's massive, was because we were expecting to all be closed up in home. And remember, some of the shares were not making sense to the reality of what was going on. So if we have a look at the GFC period, here is the GFC. Look at McDonald's and look at what happened and look at how it came out of that phase. So it had a big growth phase actually coming out of that. And that's why this may have some recession-like properties. Look at that recession-like properties that were happening there. Again, it's one of those things that I look at when I'm looking at stocks. Another one, we won't cover it too deep today, is to think about cash flow with businesses. Again, McDonald's is going to be receiving cash flow throughout the recession. Therefore, it's going to be pretty good. The current crisis stopped cash flow for many businesses, but McDonald's is easily strong enough to hold through that. AGL is a gas electric company in Australia. So they provide all sorts of things. You can see here, if you pause the video, you'll be able to read about all the things they do. So the forward PE right now is quite low. It's only 13.4. There are a few reasons in Australia why it's so low. And one of them is that the government kind of got involved in the gas electric idea of gouging price, and they have lowered how much profit these companies can make. But that doesn't change the fact that it has recession-like properties, good cash flow, and right now, not many people are necessarily looking at these industries because of the other, I guess, better looking stocks to them and what they see. So I think something like AGL, or in America, if you're looking at stuff, I just noticed there was Duke and other ones. I'd have to do research, but there are quite a few options, and it's just an industry that's worthwhile considering. And again, the same principles apply. Good cash flow, better cash flow coming, especially if you have builds and other things that demand huge amounts of electricity and huge amounts of providing, because all of a sudden, all the businesses are going to be reopening and they're all going to be paying the electricity and the gas and all of these types of things. It is a core staple to society. You must pay for these things. So unless the government gets involved, there potentially could be some pretty good profits here over the longer term. So where is AGL? Well, AGL is around this price here. We can see what it's done for a long period of time. Did it suffer through the GFC? Well, here's the GFC. It suffered a little bit, but in general, it's been pretty defensive. It pays a pretty good dividend as well. I think it's about 4 or 5% depending on the time. So AGL does have some growth properties. It's not my favorite stock. It's just one that I want to highlight here in Australia. And it is one of those ones where it has the ability for you to be in the market, potentially look at returns, but at the same time have the defensive-like risk properties, which allows you to think about at night, wow, I'm in this defensive company that is going to be okay. And that is really important. You don't ever want to be at home at night sleeping and you've just seen the stock market crash and you think, oh my goodness, I'm in a stock that is in growth phase and it could be coming out of growth phase. Because you can lose 50% very quickly when a stock comes out of growth phase. I'll repeat that again, 50% very quickly when stocks come out of growth phase. So let's now talk about the stock market. And it looks like the stock market is still in its bullish momentum, kind of hectic bull movement up. I've done a little bit of tech TA here where I've drawn up a resistance between 2950 and the 2800 zone, and I've extrapolated that out as basically a little bit of a channel break, and that puts us back into the 3126, which we're fast approaching. I mean, I think even the pre-market is up a little bit and we might be sitting around 3090 right now. So 3126 definitely very possible, 3200 certainly very possible. And I've maintained through this, if you're looking at just picking a level to short, it's going to be very difficult to know. Remember, we need to see retail sentiment completely drop off where nobody believes it's going to sell off anymore before anything is going to occur. Because Wall Street likes stealing money from other people, and that is what they're going to do this time around. Just like any other time that's ever happened in any stock market. It happens when you least expect it. So in this video, we've covered our thoughts on, of course, looking at other sectors, and that's just one of them. There's going to be so many more on this channel. So make sure to subscribe and hit that bell if you want to find out more of the things that we look at and the reasons we look at things when it comes to investments. Hopefully you've enjoyed this video today. Give it a like, comment down below with your favorite recession-proof stock, and of course, we'll see you in another video. Happy trading, everybody.